Everyone is talking about AI, but almost no one is talking about the one thing AI cannot exist without. And that blind spot is already creating one of the biggest investment disconnects heading into 2026. While investors fight over chip stocks and software valuations, a quiet crisis is forming underneath the entire AI boom, and it's a crisis of power, not ideas, not data, electricity. And the scary part is this: the grid was never built for what's coming next. Data centers don't sleep. AI models don't pause. And demand isn't rising gradually, it's surging all at once. That mismatch is already forcing big tech to make moves that most retail investors haven't even noticed yet. And if you understand those moves early, you position yourself where the real leverage is forming. Before we go any further, quick professional note. This content is for educational purposes only and is not financial advice. Stock prices move fast, conditions change quickly, and anyone considering an investment should always check the latest prices and do their own research. With that said, let's talk about what the market is quietly missing. Here's the key insight. Most people don't grasp yet. AI is not a software story anymore. It's an infrastructure story. Every new model, every new data center, every expansion by hyperscalers multiplies electricity demand, not linearly, but exponentially. One modern AI-focused data center can consume as much power as a mid-sized city. Multiply that by hundreds of new facilities planned across the US. And suddenly, the question isn't who builds the smartest AI, it's who can keep the lights on. This is where the real tension begins. Renewable energy alone can't solve this. Wind and solar are intermittent. Batteries aren't ready at scale. And data centers require one thing above all else: constant, uninterrupted baseload power, 24 hours a day, every day of the year. That requirement immediately narrows the field to a very small group of power producers, and this is where the opportunity hides. Notice what hasn't happened yet. Most investors are still treating energy stocks like slow, boring utilities. Low growth, low excitement, but AI is changing that perception in real time. Power companies that can guarantee reliability are no longer just utilities, they're becoming strategic partners to the most valuable companies on Earth. And when energy becomes strategic, pricing power changes. Contracts change. Valuations change. Now, here's where things get interesting. Big tech isn't waiting for governments or grids to catch up. They're locking in supply years, even decades in advance. Long-term power purchase agreements, dedicated generation, priority access. These aren't small experiments. They're massive, forward-looking commitments that signal one thing very clearly. The power crunch is real, and it's already here. At this point, you might be wondering which companies actually benefit from this shift. Not in theory, in reality. Not hype-driven names, but operators with real assets, real scale, and real leverage over the grid. And this is where we finally narrow it down. The first company sits at the center of America's most reliable form of clean baseload power. It operates the largest nuclear fleet in the United States. Nuclear isn't flashy, but it does something nothing else can. It runs nonstop, no weather dependency, no fuel volatility like coal or gas, just consistent output year after year. As AI demand explodes, that consistency becomes incredibly valuable. This company has already begun securing long-term contracts with major technology players who want carbon-free uninterrupted electricity for the next decade and beyond. That's not a coincidence, it's strategic alignment. When hyperscalers plan data centers, they're not thinking in quarters, they're thinking in decades. And they want power partners that can match that timeline. That company is Constellation Energy. Constellation isn't just riding the AI wave, it's anchoring it. Its nuclear fleet gives it a moat that very few competitors can replicate, especially as regulatory barriers make new nuclear development slow and complex. That scarcity alone increases the value of existing assets. On top of that, Constellation has been capturing rising capacity payments as grids tighten, meaning it gets paid not just for producing electricity, but for being available when the system is stressed. Now, always check the latest price because it moves. But what matters more than today's number is the trajectory. Investors aren't paying for yesterday's utility business, they're paying for tomorrow's AI-powered grid reality. Long-term contracts, rising demand, and a national push for clean baseload power put Constellation in a position that looks less like a traditional utility and more like critical infrastructure. But here's the second layer, and this is where many investors stop paying attention too early. Nuclear alone isn't enough. AI demand isn't smooth. It spikes, it surges. It stresses the grid in unpredictable ways. That's where flexibility becomes just as important as reliability. The second company, this one doesn't rely on a single power source. Instead, it runs a hybrid model, combining nuclear, natural gas, renewables, and energy storage into one diversified system. That flexibility allows it to respond to peak demand, price volatility, and grid emergencies in ways that single-source operators simply can't. When power prices spike, this company can dispatch exactly what the grid needs when it needs it. That company is Vistra Corp. Vistra's strength lies in its adaptability. Natural gas provides rapid response generation. Nuclear delivers baseload stability. Renewables support carbon goals. Storage smooths volatility. Together, they form a system designed not for the past, but for the chaos of future demand. That's exactly the environment AI is creating. What makes Vistra especially compelling is that it hasn't just focused on growth, it's also been disciplined with capital. Strong cash flows, shareholder returns, and buyback programs signal management confidence. Again, always check the latest price. But the story here isn't short-term movement, it's structural positioning. Now, step back and look at the bigger picture. AI isn't slowing down. If anything, adoption is accelerating faster than forecasts predicted even a year ago. That means electricity demand forecasts are likely to conservative. And when demand outpaces supply, the companies controlling supply gain leverage. That's not speculation, that's economics. This is why power producers tied to AI infrastructure are starting to trade differently than traditional utilities. They're being re-rated, slowly, quietly, and often before headlines catch up. By the time everyone agrees this is obvious, the easy gains are usually gone. The final thing to understand is risk, because elite investing always considers both sides. Regulatory changes, political pressure on energy pricing, and execution risk all exist. Nuclear perception can shift. Natural gas pricing can fluctuate. That's why diversification within power generation matters. It's also why long-term contracts are so important. They reduce uncertainty and stabilize cash flows in an otherwise volatile environment. So where does that leave us heading into 2026? It leaves us with a market still obsessed with AI brains, while the real bottleneck is AI power. It leaves us with two companies positioned not on hype, but on necessity. And it leaves investors with a choice: chase what everyone already sees, or study what the system quietly depends on. Because in the end, AI doesn't run on code alone. It runs on electrons. And the companies that control those electrons may end up being some of the biggest winners of the entire AI era. Long after the excitement fades and only fundamentals remain, that's the shift most people haven't priced in yet. And as always, stay disciplined, stay curious, and stay focused on where the real fundamentals are moving, not the headlines. Thanks for watching. I'll see you in the next video.